You right there, Bob?
I am, but you caught me half asleep as I'm looking at another website. I was about to call you the other day. We missed you last week, didn't we?
Yes, both days.
Everything okay?
Yeah, just work. I had to travel to Pleasanton.
Where?
And then Pleasanton,
Oh,
California.
up by San Francisco, right?
Yeah.
Okay. Pick up a good car up there?
Another Prius, and then I flew out there, drove it back. Drove to Oceanside on Thursday and picked up another one and drove it back.
See the state, huh? From north to south, huh?
Yeah.
You notice a difference in my location here?
I do. I was going to say,
I'm on
is this-
campus, baby.
you're off campus?
I'm on campus.
Oh my goodness.
Well, we're not open really, but I'm vaccinated and I have no symptoms, and I fill out a little survey in the morning. You know, it's an automatic thing, and they tell me if I can come in. So anyway, I got people working at the apartment doing stuff, so glad to be here.
Right.
Did you keep up a little bit with chapters 10 and 11?
I did. Honestly, I did mostly everything from my cell phone while I was on the road.
Okay. Were you able to watch lectures or anything?
Honestly, no.
Okay, and you were able to go through the book and kind of get the feel of it?
Yeah. Mostly because it's money.
Yeah, that's true.
And it's so I come from a family business, so I understand a little bit.
Yeah.
So that was helpful.
Okay.
And then having my own business, so I didn't obviously understand the purchase requisition, purchase order. I do understand that invoice. The freight I had no idea about.
Okay. Let's if that's okay with you, let's go over it now, okay?
Sure.
And if no one else shows up, you know, that's all to the better. If someone shows up, they can join us and bluff their way through it. When I asked them, have you kept up with everything, right? Okay, hold on here.
Get some light in here.
Delete these guys.
Good morning.
Hey, good morning, Rodrigo.
Hey, new location, huh? You moved rooms.
I'm in my I'm on campus actually. I'm in my office at school.
Oh, okay.
Yeah, I was just telling Anthony, they allow me to get in here, and as long as I fill out this little survey that I'm not dying, and I am vaccinated, there's nobody in the whole building, there's nobody on campus except me.
So no whiskey today. Oh, well.
I've been going from refrigerator to refrigerator, seeing if anybody left any soda behind. Fortunately, someone did. So, okay. Anthony and I were just talking about chapters 10 and 11. And would you mind if we go over those briefly, Rodrigo, before we get into chapter 13?
I'm sorry. Mind if we go what now?
If we review chapters 10 and 11
no
briefly. Okay. So hold on here. Let me get.
I think we did those last week, didn't we?
Yeah. I just want to spend just a few moments here, if you don't mind, with Anthony, who.
That's fine. I'm gonna go. I got to turn on a computer over here. I'll be right back.
Okay. All right, Anthony, hold on here. Let me find this thing.
No worries.
Chapter 10 and chapter 11. Let's open them both. Yeah, I'm just going to take you through the high points here, Anthony. And,
Okay.
and I know you keep up with the work, so
I try.
I'm not worried about that at all.
I'm not gonna lie, it's a little difficult on the phone, but I make it happen.
Share screen.
His mom died, so the trust was for the mom.
Share screen.
So he had no clue what was going on. What's this? What's that? Have you done it? I don't know.
Nice.
And I'm like, okay, we'll figure it out. Just start handing me shit. And I gotta return.
Okay, Anthony, like we were saying, you know this stuff about different forms or purchase requisitions and things. You know what a retailer is as opposed to a wholesaler or sales ticket. These are easy points on any test, right? I ask you about this. Sales invoice. Okay, here's the accounting part of it now. Customers return things, right?
All right. Not gonna lie. I did yell at the computer screen over the homework section of the numbers. Boy, I don't know if we had the same issue as we did last time, but sometimes I would enter a number and I click next and then go back, enter the tax, for example, then it would be okay. And then some it wouldn't. So honestly, I skipped quite a few because it was kind of, it was frustrating.
Okay, we're just gonna go through the high
On which
points.
homework was that?
I was going to say, Rodrigo, on some of the homework, I would enter in the correct number and
Yeah.
it would give me the X that it's wrong. And so my I would run it to my mom, who's a math teacher, right? I'm like, hey, maybe I'm doing something wrong, right? And
Yeah.
she, you know, she'd get down the full breakdown as I would. And I'm like, okay, I'm not crazy. At least I got that down. I'd enter the numbers, it would give me the X. And honestly, I got so frustrated, I just clicked next.
Oh,
Really?
I didn't have any problems, luckily.
That's nice.
So if you get a chance, I'll give you my email. Just call me. We can remote together.
Okay.
Yeah, that would be great if you guys buddied up a little bit like
Yeah,
that.
that'd be nice because I think I'm ahead on the homework.
Okay,
Well,
So
that's nice.
most of the ones due next week, I'm done with, and we can go over those. But I did
Yeah,
have some issues. You know, I would have to do one night, get as much as I could, then I get frustrated. I'm like, come back tomorrow. And then the next day it made more sense.
Yeah, isn't
Okay.
it funky? Like I forgot one night it was, I was frustrated and then I did it the next morning. I'm like, this was a lot easier today than it was last night. So
Yeah, exactly. So I would just leave it, come back another day, and it seems to be, it works that way.
yeah, sometimes walking away from it for a few hours is the best thing you can do.
Mhm.
Not that you're interested in my personal world all the time, but I took the CPA review course before I took the test back in the early, about 1983, I guess
Yeah.
it was. And among the bits of advice was, this is a 2-day, 8-hour test each day. Okay. So it's rather lengthy and grueling. And their recommendation was, you will get frustrated. You will get up, take a walk, go to the bathroom, splash the old water, you know what I mean? And then come back. I
Yeah.
think it helped me. I think it did.
Yeah.
Okay. What we're going to do, Rodrigo and Anthony, we're going to cover the real accounting guts of this chapter. These are new accounts you're seeing: sales tax payable, sales returns, allowances. We're not going to do those credit refunds. And I want to get into well, here's a quick example with sales tax, guys. You see this, Anthony? For the first time you sold something and the sale was $100, right?
yes.
But you had to charge the customer $5 sales tax. So they owe you $105. The 5 is not part of the sale. We understand that.
Yes, I
The
do.
5 doesn't even belong to the company. That's $5 we're responsible for turning over. So there's a little example of a new journal entry, and it could be a cash sale, of course. Now, here's what I'd like to go over briefly before we get into chapter 13. We're talking about contra revenue accounts. Contra revenue accounts. You never debit sales, you never debit sales. That's a very important thing to remember, never debit sales. But we do have to reduce our gross sales, which is the amount we billed out to customers. We have to reduce that to what we're going to call net sales. And since we can never debit sales, which has a normal credit balance, we use these contra revenue accounts. They're revenue accounts, but they have a debit balance. And they're married, all of these contra accounts are married to sales. Just like allowance for bad, we didn't get to allowance for bad debts. I'm trying to think. Yeah, like accounts, here's one we did do. Accumulated depreciation, that's a contra to buildings and equipment, okay? So we're gonna go over these contra revenue accounts. These are used to record sales returns from customers, allowances. So let's take a peek here. Somebody returned goods that had a sales value of $46. They bought a book or something for $46. They're returning it. We never debit sales. What do we debit? The contra revenue account called sales returns and allowances. Okay. That's the important lesson here. You never debit sales. We also have to return to them the sales tax. Sales tax, they don't owe us that money anymore. That'd be nice if somebody returns something to us and we tell them our policies, we keep the sales tax. Not gonna happen. So the total credit or cash refund is gonna be $48.30. Sales returns and allowances. Sales returns and allowances. An allowance might be this. They returned that book to us for $46 and we don't want it back in our inventory. We're just gonna throw it out. So we tell the customer, look, how about if I cut the price in half? You wanna keep it? If they did that, it would be a $23 sales allowance. Sales discounts. Now, I bet you're pretty good with this, Rodrigo and Anthony. Sales discounts. This is not the discount where you walk into the store and you see, oh, half off on computers today, okay? Priuses, price knocked down to, invoice price, that type of thing. No, these are very specific cash or sales discounts. This is a discount offered by a seller to encourage the buyer to pay early, okay? We want the buyer to pay early. So we're gonna offer, in this case, a 2% discount. The terms are 210 net 30. That's how you read that, 210 net 30. Do you remember what that means, Anthony, 210 net 30?
2% off in 10 days, and within 30 days, it's the same.
Yeah. And as a businessman, you would be nuts not to take a 2% discount.
Absolutely.
Because that's the same as getting 37% a year. Did you know that? If you find a bank that's going to give you 2% on your money every 20 days.
That's impossible.
Well, yes, it is impossible. Unless this was the 1970s. If this was 1972, when I was
that'd
at
be
work,
nice.
interest rates were 20%.
5% in a savings account.
What'd you say?
5% in a savings account.
Oh God, no, more than that.
At least when I was a kid, that's what it was, 5%.
Oh, okay. No, you can get 10, 12% in those days. If you bought a house in those days, you might have to pay 20%, believe it or not.
Wow.
That was a period of what they call roaring inflation. Okay, here we go. We
You think
sold
we're heading
some.
back to that now?
What's
Soon?
that?
You think we're heading back to that with all the money they're printing?
We have to have some inflation, but God, no. We always need a little inflation to keep the economy going.
They're
Nothing like
printing
that.
trillions.
It would be good for an old goat like me though, because I'm not buying anything. All I'm
Right.
doing is spending my
Right.
money.
Your money becomes cheaper.
Yeah, exactly.
Yeah.
I'm making out good.
Yeah.
Sales discount. Just remember this, guys. When you make the sale, you ignore the discount because you don't know if the customer's going to take the discount, right? So there's our normal debit, receivable, credit, sales. And now they paid us within 10 days. They paid us within 10 days. So we're going to credit accounts receivable. They no longer owe us that $100, but we only got $98 in cash. The debit is not the sales, but the sales discounts. And then they're just talking about, and this I'm not going to go over too much. Here are some journal entries. They're all the same entry, and they're just showing you how to post. By now, we know how to post to the ledger, right, guys? That should not be a problem. I'm assuming that, Anthony, you're okay?
Yeah.
I don't want to force feed your answer, but if you have questions,
No, it seems I seem to not have an issue though. It was just the numbers that on that one homework. That was pretty much it.
yeah, you have to show that to me later on. And you have a ledger for each customer too. So that's really what I wanted to go over in terms of catching you up a little bit, Anthony, understanding those contra revenue accounts, okay? That was the sales side. And as Rodrigo could tell you, when we get into chapter 11 here briefly, hold on, share screen. What happened to my share screen? Now, Anthony, chapter 11 is sort of a mirror of chapter 10. Now we're on the purchasing side. There are a couple of little differences. You don't have to worry about credit card fees if you're the purchaser. You don't pay those.
No.
The seller pays those. But what we called What we called a sale earlier is now a purchase, and that's a cost. That is an expense until we finish this lecture when we get into the next chapter. But right now we're in what's called a periodic inventory system, which requires a month-end inventory because we're not recording the cost of sales with every purchase. And now you have, in the prior chapter, we had sales requisitions and sales returns. Here we have purchase returns. And again, just like you never debit sales, you never credit purchases. You never debit sales and you never credit purchases. You are going to credit the contra purchases accounts. Sales discounts, sales returns and allowances and credit card fees are contra revenue accounts. They lower your net income. Purchase returns are credits to a cost. So it's increasing our income, if you want to think of it that way. What we called the sales discount in the prior chapter, hello, we're calling it a cash discount since we're the ones paying. Trade discount, just understand what a trade discount is. Trade discount is pretty much company wants to buy something from a company and they look in their catalog and they see at the top of the pages 40% off on everything in this catalog. Call that a trade discount. It's not recorded in the financial records. You don't record it. You record it at what you actually pay it. But understand that key difference. A trade discount is just you going into Costco and seeing there's a sale on pharmaceuticals or something. Okay, purchase invoice. Okay, here we go. Now take a look at these four accounts. Purchases and sales are the same thing. One man's purchase is another guy's sales. Purchase returns and allowance, a perfect mirror of sales returns, and the same thing with purchase discounts. But we're throwing in a fourth cost, freight in. Freight in is not a contra purchase account, it's an expense. Freight in is an expense. That's the cost of getting it on a truck and having that truck bring it across the country to my lovely hometown in Newark, New Jersey, okay? Freight in. And they're showing you some new accounts. And I want to, now here's a purchase return. We debited accounts payable. We returned something. You returned something to Rodrigo. So you, Anthony, you don't have this debt anymore. So you debit the credit, the credit balance of accounts payable to zero it out. And you credit not purchases, but purchase returns and allowances. Rodrigo, on the other hand, he's a little mad at you. He's debiting sales returns and allowances. You return something to him, and he doesn't have that receivable anymore.
Hey, you know how you fix all that, Bob?
What's that?
You know how you fix all that?
How?
All sales are final.
Can you imagine a business that has that sign, all sales are final, and we don't accept credit cards? That's really limiting yourself, huh?
No, that's me. I don't do returns and I do cash only.
There you go. You tell your people what you want to do. It's up to whatever works for you. Purchase discount. This is an exact reciprocal of the sales discount here. This guy, you owe Rodrigo $100. You took the discount now. Everybody's happy. You got a 2% or 37% a year discount, and Rodrigo's happy because he got his $98 right now, and he can, employ it fruitfully. Freight in. As we get to the next chapter, freight in is going to become part of the inventory cost. Okay, we haven't worked with what we call the classic inventory yet. Freight in. Transportation. Is this where you got a little confused, Anthony? Freight on board?
No, it was something I never had to deal with, honestly, because we had a service business growing up.
Okay. This is sometimes a point of contention among companies, because sometimes it's very important that for you to have shipping point or destination. FOB shipping point It's the exact point in time when the title changed hands. So if I buy something from you and I tell you, please ship it FOB shipping point, the moment that truck closes the door and starts to leave your factory, I own those goods, Anthony. If that truck drives across the Colorado River, the Mississippi River, into Pennsylvania, and then it has an accident on the New Jersey Turnpike, I'm responsible because I bought it. I owned it at that point. Destination is the opposite, FOB. Again, we're not in the classroom, it's not my class, but I always like to emphasize this a little bit, okay? And Rodrigo, this may be repeating a little bit, but I was telling people last week, Anthony, where I used to work, if I was short of cash, I would order some inventory and ask them to ship at FOB shipping point. Say that was $100,000. I had a deal with the bank where I could always borrow against the inventory. So once I had that 100,000 on my balance sheet, the bank would immediately let me take 80,000. That's a dangerous game. It's like playing floating checks in a way.
Yeah.
Look at your freight. Look at your freight. Material was purchased, and we got a bill from the vendor. The guy who sold us this stuff, he's telling us the freight was $38. Make the check payable to him. Okay, $438. I don't think that's too much of a problem. Here, we're paying the 38 again, but we're paying the 38 directly to the freight company. He told the freight company, I don't want to deal with you guys. Just send the bill to Bob, okay? Understand gross profit. Gross profit. Sales minus cost of goods sold equals gross profit. Gross profit minus operating expenses brings us to net income. So this is new. Some clowns get silly at night. That's my acronym for this. Some clowns get silly at night. Sales minus cost of goods sold, see, gross profit. Some clowns get selling expense, admin expense, net income. You guys can use that if you like. I got a feeling nobody likes that anyway. Okay, so we're going to start with our net sales. Actually, probably start with the gross sales minus the returns to get to net sales. Net sales equals sales minus sales returns and allowances, sales discounts. This is how much we charged out to people. We're going to subtract the cost of goods. We're going to get the cost of goods available first. Available. I think this will be easier if I show it to you right here. You can both read that, right? Okay, Anthony?
Yep.
No, the heck with you guys. I can't read it. Okay, here we go. Take a look at this here. We have sales. You notice how much longer your income statement is now? We used to have just sales, and then we had expenses at the beginning of the course. Now look at this thing. So you're starting with what I'd like them to call gross sales. Gross sales were 201. People returned things and took discounts. So our net sales are 199,300. Now we're taking the information they gave us a couple of slides back. We have to calculate the cost of goods sold. And it's not too tough once you've done this a few times, and it makes sense. They told us how much we had in the inventory at the beginning of the month. They're telling us how much we purchased, but we also returned $1,800, $800 worth of merchandise and took $1,000 discount. We can call that net purchases, and we add the freight. And that's a long-winded way of coming up with the amount of purchases, the cost of what we purchased. So we had $26,000 at the beginning. We added 103. Add them together, guys. That's how much is available to sell. Anthony, you had 26,000 Priuses lined up around the country, right?
Yes.
And then you purchased 103,500 more. The most you could possibly sell, therefore, is 129,500, right?
Correct.
Okay, so get familiar with this. Well, at the end of the month, guys, we either sold the 129.5 or we didn't. What we didn't sell is in the inventory that we counted. We counted $18,000. That makes the cost of goods 111,000. Sales minus cost of goods equals gross profit. So you'll be practicing that little calculation. And I'm not going to go into the ledger here. Okay. So hopefully, Anthony, that gets you caught up a little bit. And I hope you didn't mind a little review, Rodrigo. So we can go into chapter.
Yeah, reviews are always good.
Yeah. Okay, we're skipping chapter 12 for a reason. It's about journals. And if you guys continue with accounting, you'll get tons of journals to work with. And I will go over it maybe at the end of the semester a little bit. But I don't think it's going to be anything you have to worry about testing. Okay, you notice what that title is now. That's a crucial thing to understand. Accounting for merchandise inventory. Up until this point of the course, when we buy something, it was a cost. It was a cost because at the time of the sale, we only recorded the sale. We debited cash and we credited sales. We did nothing about debiting cost of goods sold or crediting the inventory. Now we're in a system where we're more of a sort of a perpetual type situation now, okay? With this method here, we are going to record both the sale and the cost of goods sold at the time of the purchase. Explain the impact of merchandise inventory. They're kind of jumping subjects here. All right, let's take these in the order they give us. Why fight City Hall? What they're talking about here, Anthony and Rodrigo, is if you make a mistake counting the inventory in, say, April, obviously your April financial statements will be wrong and you will report net income that is wrong to the extent of your inventory error. For example, if you undercount the inventory, you're going to understate the net income. Undercounting the inventory understates the net income. So April is going to be screwed up. But guess what? May is going to be bad too, because that mistake is going to follow you into May's beginning inventory. And now May's net income is going to be too high. So you make an inventory mistake counting in month one, it's going to foul up both month one and month two. And where I used to work, we had a lot of what they called intercompany accounting, where divisions and factories were moving goods back and forth to each other. And if we made a mistake on that type of intercompany accounting, it not only screwed up the company overall for 2 months, but every division that made a mistake. And the bosses got so mad, they flew everybody in, and I'm not exaggerating, from around the world. Poor Irma from Indonesia had to fly back to New Jersey to get yelled at for 2 days with everybody else. Okay, the effect of inventory errors. So let's understand this. You understate the inventory, you're going to make the cost of goods sold too high. And the reason is, if you remember that calculation we just did, we said that whatever's in what's available can only be sold at the end of the month, or we still have it. If we don't have it, we assume it's in cost of goods sold. Therefore, if we don't count $10,000 item, we're going to be putting that in cost of goods sold. Understanding the ending inventory undercounting. Cost of goods sold overstated, net income understated, everything is fouled up. Overstating it, then you're going to look too good. And they're just demonstrating it here. And I think this is worth a quick review. I happen to think that this is a pretty good presentation. I normally do this in Excel and have the numbers pop up, but we can work with this. Well, look what happened here. The ending inventory should have been 20. And things were done right in the first example. So because they did things right, well, they're using the same numbers just to demonstrate that the net income wasn't affected, okay? This is correct and that's correct. Please look at what happens when they understate. Understate. Here they made a mistake. They only counted 15. So when we subtracted 15 from the 129,500 or whatever number it might be, we're putting too much into cost of goods sold. We think we sold these things when we did not. So what happened here? We screwed up this month by $5. We're going to report a profit of only 25. And then the next month, it's going to be going up to 35. What happened in this month is going to have the opposite effect the next month. And that's the key point to understand. Here, I keep trying to do it with my fingers. Here, instead of counting 20, they counted 25. So that made the income this month 35, which is wrong, and 25. It's an important concept to understand, and it's low-hanging fruit on the test. You might get a question where they say Johnson Company counted a $10,000 item that they should not have counted. What's the impact on the 2 months? Now we're getting into something where we're going to talk about the periodic system, which we've been using, and the perpetual inventory system, which most of the world uses. Periodic, class, this is what we've been doing. We've been buying things and we're calling them purchases. And we only come up with the inventory at month end by counting it. We have no choice, because when we're selling something, we're not relieving that inventory, not at the point of sale. Perpetual inventory system, that's exactly what you're doing. Exactly what you're doing. You are going to, I'm so sorry. Under this system, merchandise inventory reflects the current inventory. Purchases are debited to inventory now. We just went through a chapter 11 where we said purchases are what you debit. Yeah, if it's a periodic system. Now we're in a perpetual inventory system. We are going to debit purchases to an asset account called merchandise inventory. Merchandise inventory. So let's take a look at this. If we do that, we may not have any need for end of year adjustments on the inventory. We can say to ourselves, we know how much inventory we had because the perpetual says we have it. The perpetual says we have $10 million worth of inventory. And you'll see a big list of all the items you have multiplied out, 8 gaskets times $20, etc. You may not have to take a physical inventory at month end. Hopefully you don't. What you might do, though, is what our company did and what a lot of places do, is called take cycle counts every day. Every day I would chase somebody from the accounting department down into the factory, and I would have them count maybe 3 items. One, an expensive item called an A item, one moderate, a B, and maybe a couple low-hanging ones. And they would come back up a half hour later, perhaps, check it against the perpetual. If those quantities agreed to the perpetual, it gave us a sense of comfort. If this happened 2-3 days in a row, good. If there was a discrepancy on the 4th day and it was a little bit small, we wouldn't do anything yet necessarily. It could be noise in the system. Next day they go out, things are back in shape. At the end of the period, you have a very good sense that your perpetual is correct. Let's take a look here, guys. Understand the differences in these journal entries. We purchased merchandise on account. Up until this moment in time, we debited purchases credit AP. That's a cost. Now we're debiting the asset merchandise inventory. And our perpetual says we now have an additional $100, whatever this stuff is, okay? Well, we had to pay the freight. Remember that $38 freight charge? This time it's 30. Under the periodic, we debited the expense freight. Notice this key difference here, Rodrigo, huh? We're debiting the merchandise for the cost of the freight. Under the perpetual system, the cost of freight in becomes part of the inventory value. Now, here's the key difference. This is the key difference. Under what we've learned so far, we sell something, we sold it for 80, the cost was 50. Okay. Well, so far, all you guys have learned is we debit accounts receivable and credit sales. We don't even look at that $50 under a periodic system because we have no ability to record it at the point of sale. On the perpetual system, we certainly do. So now each sale under the perpetual system is going to have four, count them, 4 accounts. So let's take a look at it. We're going to have the same exact entry for the sale. That doesn't change. We're going to debit receivables for 80, credit sales. But we're also taking that $50 cost and we're debiting cost of goods sold, which of course is an expense. Cost of goods sold is the expense representing what you paid for the item you bought. We bought a garment for $50 and we sold it for 80. We have a profit of $30. So you debit cost of goods sold for the cost of the goods and credit the inventory. Okay. Somebody returned something to us. Somebody returned something. Well, if we're the ones returning it, and I guess we are here, we're going to debit accounts payable and credit purchase returns and allowances. But look at this, Anthony. We're going to debit accounts payable, but now we're going to reduce the inventory. Okay. Customer returned something for $20. We had paid $15 for it, guys. Okay, they returned $20. Well, we know we're going to debit sales returns and allowances for 20 and credit accounts receivable. And I bet that's the same for both systems. And it is. It is. But under the perpetual system, we're always concerned with recording the cost of goods sold and the resulting inventory reduction at the point of sale. So they returned the goods to us. Well, we lost that $20 sale, but at least we got our merchandise back. We'll put it back in the inventory, and that reduces our cost of goods sold. So we originally had a $5 profit, and now we have no profit at all. And then you pay with a discount. Purchase discount. Notice there's no purchase discount under a perpetual inventory system. Under a perpetual inventory system, you should be noticing that a lot of these ancillary costs, like freight in, like purchase discounts, okay, they end up going into the merchandise inventory itself. Oh, we're gonna have some fun here. Okay, hold on now. Compute the costs allocated using different inventory methods. And then they skip ahead here a little bit. To determine the cost of goods sold in inventory, let's understand the purpose of a physical inventory. The physical inventory is a wonderful opportunity to adjust your cost of goods sold and the inventory balance to their proper levels. You take a physical inventory and you're comfortable that it was done accurately, you go, at least as of December 31st at midnight, we know we have a good inventory number there. And there are certain calculations done under the two methods, periodic and perpetual. And I'm going to go over the rule of lower of cost or market. So taking a physical inventory, you have to do it under the periodic system. You have no choice. You can do it under a perpetual system. And we did at Thomas and Betts. We took a complete physical inventory of our factory October 1st. I don't know why it was October 1st, but October 1st every year. And I hope I'm not repeating myself, although I probably am. October 1st, 1987, the inventory didn't go too good. because as we were starting the count, we had visitors from New Jersey out there, we had the auditors. 20 minutes into that count, the Whittier Narrows earthquake struck. All the lights went out in the place. The joint was shaking. We hear things. It was pretty scary. And we all did what we're not supposed to do. Fortunately, no one got hurt. We all like ran out to the nearest exit. And that plant was, long story short, that plant was condemned. And we were only allowed to stay there for the rest of the year. And at that point, it had to be knocked down. I digress. Where was I going with that? Oh, yes, we took a physical once a year, even though we had a perpetual system. And some companies even closed for a few days. Yeah, we did. It was a 3-day thing. The ideal, you try to count the inventory when the quantity is at its lowest level, if you can. For example, Macy's is not going to have a full inventory going at the end of December. They'd be nuts to do that, or at the end of November. Maybe at the end of February, after the Christmas shopping season. Inventory sheet, I counted 20 tables and I multiply it by, you get the idea. So they counted a table. There's millions of different ways of taking an inventory. Goods on consignment. Anthony, do you do anything on consignment? You know what consignment is?
I do.
Tell us what consignment is for $80, Anthony.
Consignment is when you allow another seller to sell your items and you pay a consignment fee for them to do so.
Wow, you couldn't have said it any better. That's better than in the book, huh? Consignment. Yeah. The perfume, you walk into Macy's when it was downtown, you walk into Macy's and you're overwhelmed by the smell of the perfume, if you remember that.
I do.
Those perfumes were consigned to Macy's by Chanel, say. Yeah. So Chanel says, here are 50 jugs of perfume. See if you can sell them. Macy's sells one for $100. And you're right. Then they pay us $20, $50, or whatever the deal was. Okay? Goods on consignment. The important thing to remember is goods on consignment don't belong to the people who are holding the goods. Macy's doesn't own that. Macy's would not count that in their inventory. Chanel has to be smart enough to remember it's down there and count it in their inventory. And we're back on FOB, shipping point, FOB. Like I said, FOB shipping point, the buyer's responsible for everything. Once that truck or that train toots down the track 2 inches, title is changed to the buyer. FOB destination, the opposite. Inventory costs. You buy inventory, there might be other costs involved that you have to include in the cost of the inventory. You buy a couple of big tractors, say, you're a big kind of dealer. You buy 3 tractors and they're huge. Well, it's going to cost you quite a lot of money to get them shipped to your warehouse or whatever. So the insurance cost, the freight or delivery cost, maybe storage fees, you might even have to knock down part of a wall to get it into your building. And I'm chuckling, but that's what we had to do when we got kicked out of our factory. The point is, all these ancillary costs will end up as part of merchandise inventory. Now we're getting into the fun part, and I do mean fun, because I always like doing this. When I first got out of college, I went to work for, here's a company you know pretty well, right, Anthony? Purelator?
Purelator?
Yeah.
Oil?
Yeah, Purelator oil filters. Are they still around?
They still are, actually.
Yeah. Anyway, I got hired at their Rahway factory, Rahway, New Jersey. And one job they gave me when I first started was doing the cost of the inventory. And I like doing these little calculations. They were kind of fun, not terribly hard. So we're going to look at 4 methods: FIFO, LIFO, weighted average, and specific ID, huh? Oh, let's see what we got here. Specific ID. I want to look at this carefully before I speak about it. Okay. One of the methods is specific ID. This is the only method of the four, guys, that actually tracks the physical movement of the goods. When I bought my Ford Edge, which is a real babe magnet, by the way, when I bought that car up at Perry Lincoln, I said, I want to buy a Ford Edge. And I looked them over. We signed the paperwork. I paid for it. Perry Lincoln didn't tell me, okay, Bob, take any Ford Edge you see against the wall and drive away with it. No, they're not selling bananas. They have to know exactly what car you bought, what the VIN number was, the engine, all the details about it in case there's a recall or, God forbid, some kind of an accident. So specific ID method, your problem in the book is going to tell you which ones they sold. Cost is determined from the invoice, okay? Let's take a peek at this. This is a real important piece of grid here. We're back to the world of available for sale. Available for sale. This company had 40 units on hand at the beginning of the period. Then the first week, they brought in 60 more. They purchased another 80 in the second week, and I guess another 70 in the third week. And you notice the prices are going up. Okay. Well, 250 is the most they can sell. Most they can sell. We call that the goods available for sale. How about that? The most they could sell is called the goods available for sale. The dollarization of it, 40 times 62, 60 times 65, etc. That 16,500 is called cost of goods available for sale. Huh? Cost of goods available for sale. My point being that that line there, that line, number of units available for sale, that's the same for all methods. It's the same for all four costing methods because that's the history that you're now going to use. And then at the end of the month, they counted 50 in the inventory, which means they sold 200. So let's take a peek. Specific ID. Here they're telling you, you see these 200 here? 200 sold? They're telling you, give me 1 second, guys. I want to see something. Yeah, these slides are a little bit out of order. They sold 200 printers. They're telling you where they came from. 30 came from the beginning inventory, 50 from the first, 60, 60. 30 came out of this 40. 50 came out of this 60. 50 came out of this 80, and 50 came out of this layer here. Okay, that sounds like a little bit of Greek to you right now, I bet. But let's take a look now. Here we go.
Got it.
Let's see what happened here. Well, we got to worry about two things. We got to worry about the cost of goods sold and the ending inventory. So let's look at calculating the cost of goods sold. You started by saying to yourself, well, they're telling us they took 30 from the beginning inventory. 30 times 62 equals 1860. They took 50, and from here, 50 times 65 is this number here. It looks like they took 40 from here, 40 times 67, and they took 50 from here. You multiply this out and add it down, you have come up with the cost of goods sold. Sold for 16,500, okay? Cost of goods sold. Well, let's look at the inventory piece now. The inventory. We had 30, and we know we sold 20 out of it. That leaves an inventory of 10 times 62. Here, we know we sold 40. That leaves 10 at 65. We sold 40 out of here, I guess. That left 20 at 67. And here we sold 50, 10. So the cost of the ending inventory is $3,290. That is the template, if you will, for all four methods, okay? You're always going to start with the total available and then start breaking that out. If you haven't figured this out yet, let me point out, cost of goods available minus ending inventory equals cost of goods sold. Therefore, cost of goods available minus cost of goods sold equals ending inventory. So make sure that's very clear and obvious in your brain, because you might get tripped up on a problem where they say, this company sold 30 of this, 40 of this, 60, 59 of these, they sold 29 of this, 20 to 50 of these, they sold 60 of these, they sold 58 of these. It would be easier to work with the 3 that they didn't sell. In other words, calculate the inventory first, because once you have that, you can back into the cost of goods sold number, okay? FIFO, and I hope to bring up an Excel sheet that'll get us through this a little more. First in, first out. We are assuming that we're always selling the most recent item. You go to a grocery store, you know, the bread that's up front, that's the oldest stuff probably. And we're kind of mimicking that here. And I say mimicking because it's not necessarily true in terms of the physical flows being the same. And they're saying whenever possible, the business sells the old stuff first. Yeah, grocery stores, bakeries, computers. FIFO. Take a look at your FIFO. FIFO. First in, first out. And by the way, if you master this chapter on the FIFO, LIFO, you get a lot more of this in 230. You'll be in good shape when you go there. So let's figure out the cost of goods sold. How many did they sell? They sold 200, right, guys? Where did they get these 200 from? Well, first in, first out. So we know they used up all 40 here. We know they used up all 60 here. That's 100.
All their units.
Units, yeah. Question,
Right.
Anthony?
No, I was going to say they just sold all their units because, I mean, 60, 40, that's 100, 80, 20, it's 200.
There you go. You get the idea? We're pulling them from those layers, right?
Yeah.
So you multiply it out, there's the cost of goods sold. Once we have the cost of goods sold, we can just subtract it from the cost of goods available to get the ending inventory. What was left in the ending inventory? Just the 30 at 68. So here we're coming up with an sorry guys, we're coming up with a cost of goods sold of 13,100. And it's a little lower than the specific ID. Okay, that doesn't cut much ice, but let's compare it. Let's do weighted average. Let's do LIFO. I want to do them in the right order, my order. Or you can believe me or your eyes on this thing. Okay, LIFO. Here now, we're pretending, and I am using the word pretending deliberately, we're pretending we're selling the newest stuff first all the time. Okay? The newest stuff. And companies can choose any of these methods, and you're going to see why in a moment. LIFO, last in, first out. The Mesa produce stand up by where I live on the Mesa, I happen to know that they use LIFO. And that means theoretically, they never sold the first bunch of bananas they put up there during World War II. Well, we know that's ridiculous, but that's what LIFO is. That's what LIFO is. Hey, Anthony or Rodrigo, could you guys think of a business where the goods do move sort of LIFO, last in, first out?
Dairy.
No, that would go bad.
No, that's no
We give
good.
a good example in the book about the nails. You know, you
Nails? Yeah,
you get a bucket, you take nails from a big container, and then you dump in the new one. So you're using whatever came in first. The bottom ones may not get touched because it's not perishable. So it doesn't matter.
Great example. And here's how stupid I am. I didn't know that example was in the book, but that's the one I always use, Anthony. The nails. You start a hardware store in 1922, and you fill a giant metal garbage can filled with nails, well, you never really sell those nails that are on the bottom. You're always waiting until it's about 1/3 empty or 1/4 empty. Then you just pile more nails on it. LIFO. LIFO. Rodrigo, where did we get the 200 this time? Where did we get them from? Which ones did we sell first?
Opposite. So the last purchases.
Yeah.
Purchase 3 on, going back up the list.
Yeah, exactly. 70 at 68, 180, 80 at 67, that's 180. And then 50 times 65. Not too hard, guys, right?
No, look, I did the homework last night on this stuff.
Okay, yeah, you should be an expert on this. And I do want to encourage you guys to buddy up and, maybe somebody else, if we get in there, if you get someone else in there. Okay, now I want to go back to the weighted average. Believe it or not, the LIFO and FIFO are the two hardest ones. Let's do the two.
The easiest.
What's that?
FIFO seems the easiest because it's the most common sense.
Yeah. So, sometimes the students, maybe from other nations, are not familiar right away with FIFO, LIFO, that kind of thing, kind of throws them a bit. But yeah, it's not too tough. Weighted average, this is the super easiest one. Weighted average. Weighted average. What are we going to do? Here's what we're going to do. Weighted average. We're starting with the same 250 available, right? And the same $16,500. All you do here is take that horizontal line called the units available for sale, 16,500 divided by 250 is an average of 66. How many did we sell? 200. 200 times 66, that's your cost of goods sold. 50 times 66 is your ending inventory. This is an easy one. Just don't make this mistake. Once in a while, a student says, oh yeah, weighted average. Yeah, we're gonna get the average. And what they did do is they go 62 plus 65 plus 67 plus 68. And they get the average of those four costs. That's not gonna work. The only way that works is if the units are all the same. That's why they call it a weighted average. LIFO. Now I want you to look at this here. Comparison of the inventory methods. Depending on what method the company chooses to use, you're going to have different cost of goods sold and also different net incomes. Net incomes. Comparison of the methods. So let's get the theory going here. Let's start with FIFO. What was the gross profit under FIFO? $4,900, huh? $4,900 FIFO. What was the gross profit under LIFO? If you look to the right, $4,630. That's a significant difference, wouldn't you say? Let's pretend this is a $4 million company. So the difference is not $270, it's $270,000. That means that the LIFO company is going to pay less taxes. They're going to save 30% on that 270, and they're going to save themselves about, $90-something thousand in taxes. The weighted average, what a surprise. That's in between LIFO and FIFO. And specific ID can be all over the place, okay? So companies have strategic reasons for choosing these methods. Why would you choose LIFO? Anybody got a feeling on that one?
I guess if it's not a dated product, it shouldn't really matter, right?
If it's not what?
A product that it's going to expire, as we were saying, because I brought up milk, but
Yeah, well, it doesn't. Yeah, that everything you say is true, but that's not really too germane. It's kind of like I just said. You want to report a lower income if you can, pay less taxes. because that's a lower income without any cash disbursements, really, right? You chose LIFO knowing that your gross profit's going to be lower than it would under FIFO. FIFO, you have a higher net income. FIFO, you have a higher net income, but you're going to have to pay the difference in taxes. So some companies might say, I'm going for LIFO because I want to save cash flow. I don't want to pay $90,000 in taxes if I don't have to. This company here says, well, I'm willing to pay the extra tax, but I want to make a big splash with the investing public. I want to be able to make an announcement in tomorrow's newspaper that says, Smagula Company nearly cracks the $5,000 mark, okay? And the hope is by making a big splash, people run out and buy your stock. Does it work? I don't know. FIFO, LIFO. Weighted average will be in the same.
Tesla.
Tesla, yeah, Tesla. Tesla has profits, but not from selling cars. We talked about that, right?
Yeah.
Their profits are from not buying, but selling carbon permits, which is a good thing. It's good for the environment, but that's not why people invested in Tesla. They want them to make a car.
Well,
So
yeah, they're making money off their selling credits, but other than that,
no, I don't think they're that close to, getting the car on a mass market basis yet. They are the best example of a company with horrible cash flow, and they're still showing a profit. Okay. That would be like a store who never sells anything, but they have a room in the back that they rent for a big amount of money, and that's their income.
that's pretty much what you're saying.
Yeah. Perpetual inventory. We'll just go over this a bit. We're just about getting done here. Understand what a perpetual inventory system, it means that at every moment of the day, every nanosecond, every moment in time, you know exactly what your cost of goods sold is for that period up to that point. But more importantly, you know what is in your inventory. When you go to Costco and you buy a computer, they swipe your credit card or they take your cash. And as soon as they hit the cash register, they create this journal entry. They debited accounts receivable, or, well, you're paying it now. They debit cash, credit sales for 1,000, but they also debit cost of goods sold for 400 perhaps, and credit merchandise inventory. That's why when you call Costco and you say, I'm thinking of buying 7 plasma TVs, 62-inch screen, you got them up there? They hit one button and they can answer that question immediately. If you call a periodic type place, they're going to put you on hold and have to run out and look. That's the difference. Perpetual. I'm sure as heck not getting into this, the perpetual inventory record. I'll tell you why we're not getting into this. I tutor this subject for other teachers. And one of the other teachers automatically assigned some homework to students. And one student came to me with a problem from this chapter on reconciling the FIFO and the perpetual. And it was the most complicated pain in the neck thing. And I told her I have to throw up the flag. I can't figure this out right away. I contacted the teacher, and it was Professor Reyes, heck of a nice guy. And he laughed and said he forgot to tell me that he pulled that out of the rotation because it's such a tough problem. So we're skipping that. Finally, the principle of conservatism. Conservatism is the accounting principle which makes companies reveal losses as soon as they know about them, but you can never anticipate a gain. Conservatism, you must anticipate and record a loss, and you never anticipate a gain. So what are we talking about? If an asset increases in value while being held, no entry is made. Remember that land we bought on the waterfront back here on East Beach back in 1910 when Grandpa Smagula bought it. We paid $1,000. Now it's worth 100 million. It's still $1,000 on our general ledger. We don't make a profit till we sell it. So you never anticipate gains, but you always anticipate and account for losses. And that brings us to our final subject, I believe, the subject of lower of cost or market. If the value of an item declines while it's being held, we have a loss to record. Ooh, that's good whiskey. The purpose of lower cost, recognize those losses as soon as they pop. Cost means the dollar amount using one of the costing methods. Guess what? Cost means what we paid for it. Market price means what it would cost to replace that item today. Cost or market? Cost price versus the market price. Market means the current cost to replace. Method assumes a decline in the purchase. So let's take a look. This is not difficult either, but I just want you to understand the concept because this will be on the test. And it's a very important concept going forward that you always anticipate losses. So we have an inventory. We have an inventory item. We paid $8,000 for a fancy garment, some kind of beautiful dress. Okay, we paid $8,000 for this garment. Now our salespeople are coming to us and saying, "Look, we're never going to be able to sell that dress for $8,000. It's gone out of style to some extent. Everybody else is selling them for $7,000, and they're lucky to get that." Well, at that point, we have to say to ourselves, we have a $1,000 loss. We have a $1,000 loss. So we have to select the lower of the two, lower of cost or market. Market is lower. That becomes the new inventory cost. Let's look at the next one. We purchased something for $9,000 and we're selling it for at least $10,000. Looks like lower of cost or market. Market is cost is lower. So we don't have an adjustment. We bring the 9,000 over. Here, we bought 7,000 comic books or something, and we paid $7,000 for them. Again, the market has fallen to 6,500. That becomes our new inventory, and there's our new inventory balance. It went from $24,000 down to 22,500. So we have a loss here, if I'm doing this right in my head, of about $1,500, huh? Lower of cost or market. Two ways to calculate it. The lower of all items at their cost. Okay, I'm not going to go over this too much. What they're getting at here is companies don't exactly have to take every little nut and bolt and see what the cost is. You're allowed to what they call aggregating them into big groups, okay? So, General Motors doesn't have to look at each tire necessarily, just at the aggregate. Here we go. Lower of cost or market. I believe that number should have been 1,500, right? 24,000 minus 22,500 is not 500, it's 1,500. So we debit an account called loss on write-down of inventory, and we reduce the inventory. We reduce the inventory. We used to call this, where I worked many years, cost of goods sold dash lower cost or market, okay? And here's where we're cutting off. We're not going to go into the gross profit or retail inventory methods, okay? So I think that's quite a lot for one session. What do you think, Anthony?
I liked it.
All right, back on board here, huh? And like I said, when you find a 63 Rambler in good shape, let me know. We may be able to do some business, okay?
All right.
Rambler
Any
class.
specific color?
Black if you can, because mine was black.
Okay.
I had to wash it every day, but it was great.
It's okay.
All right, Anthony, good to have you here. How about you, Rodrigo? Any comments, questions?
No, this one's been a good chapter. Easy.
Yeah, I think it's a little more interesting. Remember I remember how I talked about the first 6 chapters. You're learning what's a debit, what's that kind of stuff could really be snoozers. But this at least some
Yeah.
real world type things, and I think they play well. Okay.
Yeah.
So I guess we'll see everybody, and I'll make a motion to close the meeting. Okay.
Wait, are you gonna be teaching the summer 2:30?
Yes.
First session, second session?
I don't know. Can you take a
I'm
look
definitely
at it?
signing up.
Okay, good. I'm glad you'll be in my 2:30. I hope to see you there too, Anthony.
All right, sounds good.
I do something you're not supposed to do. I try to recruit the good guys like you. Into the class.
Yeah, I think I'm gonna like that 2:30.
Yeah, 2:30 is a lot more interesting. The first few weeks of it are not going to be because it's a repeat of this stuff. for
Yeah,
the
but
most
that's
part.
good.
But
Yeah,
but
yeah.
you'll retain more.
Yeah. Hold on one second here. Just if you let me just see something. I think I can answer your question, and I'm curious myself. I'll probably trim this part of the video.
Yeah.
Well, no,
Stop
maybe
recording.
not.
Yeah.
No, I'll leave it up there. I'll promote us.
So how do you go watch these if you missed the regular live session?
Pardon me?
How do you watch them if you missed the live session?
Rodrigo, Bob has his own YouTube channel and he uploads them there.
They're in
Ah,
Canvas.
okay.
We put them on Canvas every day. Go into your modules. You'll see them there. Any chapter.
I'm not
So I'll
gonna
have
lie,
to
I
look.
didn't find him that
Remember,
way.
this is my first time in 20 years back in schools. It's been slow for me.
I know what you mean, Rodrigo. Hey, Rodrigo, you're the income tax guy, right?
Yeah.
I'm pretty serious about this. My tax return is super simple, but I hate to do it. Maybe
Yeah.
you could do mine. I'll be glad to pay, of course, for it.
Oh, I'll help. So go to SB Tax Pros. That's my
SB Tax
website.
Gov.
No, SB, like in Santa Barbara, Tax Pros, PROS.com.
Oh, okay.
You can, there's a secure portal. You can upload your docs right there. Send me a note and I'll get on them. That way you
Oh,
don't even
okay.
have to come in.
Oh, that's great.
I've been doing virtual that way and then new clients that way.
Okay. that
Right
sounds
now,
good.
I'm in the middle of corporates. So I have like 5 or 6 corporates due
Man, oh, man.
by 2 days from now. So I told my
That's
kids,
enough.
I won't see you till tomorrow, maybe the next day. And they're freaking out. Like, why? I
Okay.
told my wife, oh, I'll be home after midnight. So
No, you tax guys are always brutally busy. I just got this email along the same subject. A student asked me, I look forward to you joining your class. It says there are 2 instructors, you and Cornelia. Do you know who will be sure teaching the class?
yeah.
So I'll have to tell them it's me. You got no choice. It's me. Now, hold on, guys, if you don't mind. This shouldn't take more than a few seconds. Let me reduce this. Get rid of that. Get rid of that. Who the
Yeah.
hell
So
am I
with taxes, I don't know how my schedule goes. So I'm trying to stay ahead of the homework. So if I can't do homework one day, I won't miss any.
Yeah, I don't know how you do it, to be honest with you. It's doing tax returns can be grueling. All right, let me get into Canvas here. Okay, so the summer unpublished 2:30, spring 2021. Okay, it looks like I have 82078 is the class. Let me just take a peek here. Yeah, I do have it, but it doesn't say when or what time or anything.
Okay. Well,
Okay, so we're there. All right, guys, you all take care.
All right, guys. Sorry, I got an auction to attend to right now.
yeah. Bye, Anthony.
All right, bye, Rodrigo.
Bye-bye, everybody.
Bye.
Bye.
Gotta go. 17, 17. So 15 number